Welcome back to the second half of the Futures Show. I'm your host, Ben Lichtenstein. Stocks and stock index futures products this morning are looking to, recover from yesterday's sell-off. They're slightly higher this morning as we await the cash open. We're less than 60 minutes from that ringing of the bell. Let's bring in Scott Bauer, the CEO of Prosper Trading Academy. He's joining us this morning to talk financial markets. Scott, welcome. Good Tuesday morning to you.
Ben.
Thanks to you, Scott. We started off the show talking about the indices and how they are, trying to rally back after a rough start to the week and a, tough start to the year for that matter. But I guess I'm wondering, with many of the headwinds that still remain, we're talking rates, the TYX, the TNX up and through 3% this week, the dollar to new two-year highs. I mean, many of those underlying, contributing factors that have indices coming off are still present.
There's no doubt about it, Ben. And we are solidly, squarely in a sell the rally type of environment where for so long, for the last few years, it was a buy the dip. There's still as you said, so many headwinds overhanging this market. So, traders need to be careful. Investors need to be careful. It's nice to have some green on the screen. It's nice to have some good news, but we can't get too complacent. That's for sure.
Yeah. I think you send a good message there, Scott, in terms of be careful. Again, all of us want to see this market start to recover here a bit. We've come off the all-time highs up around 4,800. You can see the most recent leg of that move to the downside from 4,500. We're talking about the end of April highs all the way down to 39.6175 in the overnight session. So we are, as you mentioned, off that slightly higher, up by about 1%, but the rallies have been short-lived. Now, earlier we were talking about the headwinds we found up around 4,300 last week after the rally from the Fed. Here, the 60-minute time frame kind of spells that out, a pretty well-defined triple top here, and then the weakness that ensued. But, Scott, a big part of this, the U.S. dollar, which has been on a rip. I mean, it's tough to say which came first, the chicken or the egg. Weakness in the indices or strength in the U.S. dollar or some of the other foreign currencies that have been selling off. But the greenback, again, up and through 104, back to pre-pandemic highs, or pandemic spike highs, I should say, a significant factor to be considered no matter what product you're trading here. And when you're talking financials, it is the focal point for traders, it seems like.
Absolutely, and there are still many tailwinds for the dollar, just opposite.
In terms of the fundamentals.
In terms of the fundamentals, when you look at the rest of the macro environment here, and then you compare the dollar, it's really on the opposite side here. So any pullback in the dollar is going to be met with buying opportunity, I believe. You and I talked about this last week, the week before that this new range for the dollar is probably going to be 103, 105. For so long, we were set in like that 96, 98 area. Now it's more likely 103, 105. As long as the Fed has the gas pedal pushed all the way down, whether it's 50 or 75 basis point hike in June, really doesn't matter. But as long as we are in this environment, there is going to be a bid for the dollar.
Scott, we heard from Bostic yesterday and partially supporting that bid for the dollar, as you mentioned. You said that we're going to have to move a couple times, maybe two, maybe three times. He talked about how, things are, out of control, as he mentioned. A lot of things, he said, are out of control. And you mentioned stepping on that gas pedal and pushing it all the way down. Don't necessarily, because it's going to cost you quite a fair amount at this point with pressures at the pump on the rise. We mentioned at the top of the show as well, $4.37 a gallon AAA is reporting. Record levels to fill up your car. Forget about it if you're putting in premium. That's up and through $5 plus here in the U.S. or in Chicago. And this is directly behind what we've been seeing in rates. Again, as I mentioned with you a minute ago, the TNX, the TYX up through the 3% level here, a reflection of some of those inflationary pressures we've seen. Crude oil holding above 100. It's come off the 111 from last week, but still holding that key level.
It really is, and the rates, the rise that we've seen at rates, Ben, is just absolutely unbelievable. But we've started to see the spreads widen out a little bit. We've started to see the curve steepen a little bit here. So it was just about a month ago, 6 weeks ago that we were all talking about what is a recessionary indicator, and it's when we see an inversion of the yield curve. And now you look at the 210. And that's actually spread out to about 45 or 50 basis points or so. We're seeing a lot of pressure now on the 30-year kind of spiking in reference to the shorter end. So
it's leading the shorter end.
Absolutely is. And
Yeah,
it's really
we're looking
a
at
dynamic. It is really a dynamic in the marketplace. It's across the board now where, 6 weeks ago, a couple months ago, it was all the focus was on the short end. It is now completely across the board. So that's underpinning, what's going on with the dollar. It's almost this vicious circle here. You don't know, whether the tail is wagging the dog or vice versa here. But obviously the rate and the dollar go hand in hand.
I think kind of to provide a bit of a visual to that point, if we could just take a look here, the bonds recently into that low here, down below 135. But as you take a look at all four of the majors collectively now, I've got the bonds in the top left corner, the 10-year in the top right. It has been, it seems like, the longer dated as of more recently into those new lows. The shorter dated, here's the 2 in the far right and the 5 in the bottom left. It hasn't really participated to the upside. Just again to take a quick look at those rates on the rise here. We were looking at the yield curves. You mentioned the 30 relative to the 5. Here you can see the move up we've seen, and while they backed off quite a bit, again, new highs, it looks like in the overnight, extending that move up and through to 3.25%. Scott, in terms of the tail that wags the dog, you've got some concerns related to foreign currencies, euro currencies, for example. We've seen weakness in the euro, the pound, the Swiss with the geopolitical location in terms of some of the tensions in Russia or in Ukraine, I should say, based on the war, as a reflection of the war on Russia, from Russia. I mean, ultimately, this has been supporting the U.S. dollar in addition to some of the other fundamentals that we've touched on here. But keeping a close eye on these foreign currencies, of the three, we're talking the pound, the euro, and the Swiss. Which one more closely do you have your eye on here?
I think you really have to watch the euro just because of its correlation, and probably the pound, just because of its direct correlation with what's going on Russia in Ukraine, and just the location logistically of where they are. So I think you really have to focus on those. But then, Ben, if we can expand this out to the yen as well, why is the yen so weak? Well, they haven't caught up with the Fed here, right? They've been so hesitant to address or at least face the concern about rising rates. So you're seeing tons of pressure there. But then you expand also into the commodity space. Look at some currencies like the Aussie dollar, the Canadian dollar even. How weak they've been because of what's going on in the commodity space. And we know that, as we get a stronger dollar here, that typically hits commodities here. So we're seeing lots of weakness there. We are seeing a little bit of recovery from the Aussie and the Canadian dollars. I think they just recently fell to their weakest since the beginning of the pandemic. But those are ones you got to watch also with this massive move in the dollar.
Yeah, commodity-based currencies have fared pretty well considering. Taking a quick look at some of the others that haven't, here's the yen. You were speaking to that point. The British pound recently down below 123 to 122.61. And take a look at the euro currency here, down as low as 104.90. This has been one of our paper money trades. We got short this one around the 108 handle. Scott, we were like, look, this trend is so long in the tooth. We felt a little bit late in terms of participating, but we said, let's just join and hope it continues, and it has. And in fact, we've now started to accept value at this lower level. So again, kind of solidifying the working assumption that this market has been trending lower. Scott, lastly, I wanted you to get your thoughts here on Bitcoin, because with the indices coming off, the dollar on the move higher, rates on the rise, this risk-off sentiment we've seen, Bitcoin recently below 30,000. Should we expect some of this price decay to continue here?
I don't know if we see it decay further here, Ben, but I think we've set this new range here. And what people have to remember, for the longest time, we've tried to correlate Bitcoin to rates. We've tried to correlate it, to the dollar, right? And Bitcoin has never been through a recession.
Okay.
It's never been through this environment. So there's so much unease. There's so much that we don't know about. Is it really a store of value? Is it correlated to inflation? We just don't know. And I think, in this environment where this is a sell-first environment of every risk class there is, then you get to something that we've never experienced a situation like this. And I think that's why there's additional pressure in the crypto space, and specifically Bitcoin.
quick look here, 69,000 all the way down to, we're talking 29,700. Again, as mentioned, recently below that 30,000 level. I just want to point out, Scott, because you mentioned this range that we've kind of settled into, it looks like we're testing the lower extreme of it right now. And to your point a minute ago, Scott, I mean, that was the argument many had as far as looking to Bitcoin or gold, for example, is that safe haven, for example. Gold has a history. It's been through these ups and these downs, these swings. It's time-tested, mother-approved, as I like to say, and seen it all for that matter. I mean, that's a good point. I think Bitcoin still has yet to experience that. Can you just expand on that a little bit in terms of Bitcoin versus the dollar, Bitcoin versus gold is one of those safe havens?
Absolutely. And I think from a psychological or emotional standpoint, Ben, because we don't have that hard data of years, of decades and decades of proof here, that it is just a question mark. It is throwing, throwing spaghetti at the wall, if you will, of what the correlation of Bitcoin and crypto is to the overall market. So what happens emotionally when people don't know the answer? What happens when people get in a situation of, which direction is this going to go? It is typically a sell-first mentality, and I think that is additional pressure that we are seeing on this space right now.
And a question mark's not what investors look for during times of unease and uncertainty. And, it seemed to me, Scott, correct me if I'm wrong, but that last pop up around 48,000, 50,000 was tied to Russia accepting Bitcoin for some of their energy products. But I think investors kind of realize that's not the ground we want to stand on here in terms of some of the backdoor, purchases of energy markets with Bitcoin. They want to see something a little bit more solid in terms of legitimacy there. So something to look at here as we approach these lower extremes. Again, by definition, price does not spend a lot of time down here or at upper levels as well. Scott Bauer, appreciate you joining us and sharing part of your Tuesday with us. Scott's the CEO. Thanks to you, Scott. Scott's the CEO of Prosper Trading Academy, and, well,